The Federal Reserve has just signaled what many have been quietly anticipating: a shift away from strict monetary tightening and toward a more accommodative stance. In simpler terms, the era of aggressive rate hikes may be giving way to a phase where the Fed slows down, pauses, or even begins injecting liquidity into the financial system again. Some call it the pivot. Others describe it as money printing returning through the back door. Either way, the implications are broad. To understand this pivot, you must see how the Fed influences the economy. When inflation surged, the Fed raised interest rates to make borrowing more expensive. Higher rates slow down spending, cool speculation, and ideally bring prices back under control. That phase, however, comes with side effects: business slowdown, loan defaults, and stress in the banking system. We already saw hints of that in commercial real estate, small bank instability, and declining consumer savings. Now, with inflation gradually cooling and signs of economic fatigue emerging, the Fed has confirmed that it is prepared to ease conditions if necessary. This doesn't mean they immediately start printing trillions in plain sight. Instead, liquidity returns through subtle channels: bond buybacks, balance sheet adjustments, emergency lending programs, and reduced pace of quantitative tightening. These tools quietly add dollars back into circulation. What does this mean for everyday life? Assets respond first. When money becomes easier to access, financial markets often rise. Stocks, gold, and crypto tend to strengthen because investors expect future dollars to be worth less than today's. Real estate behaves a bit differently. If rates fall, mortgages become cheaper, which can support or even lift home prices again. However, affordability remains a key factor for buyers. For consumers, a pivot can feel like the economy breathes out. Loans ease slightly, companies may hire more boldly. But there is always a balancing act: ease too much, and inflation can roar back stronger than before. The takeaway is not panic, but awareness. Monetary policy works in waves, and we are approaching the crest of one cycle and the beginning of another. The pivot does not reverse the past 2 years, but it opens a new chapter in how money moves, how markets behave, and how wealth is positioned for the future. If you'd like, I can now. Turn this into a YouTube script. Make it more dramatic or more conversational. Add examples with charts.